Hey, look, I think you put your finger on a really interesting question there, because, and I can phrase it as follows. I can say, look, was November 2020 the turning point in the same way that, March 2000 was? And, we've had a really great year. The fund is up 13-14%, which is actually better than the first year after March 2000, I should say. But there is one part of the picture that doesn't fit in, and that is that on the other side of the spectrum, on the speculative side, on the high growth side and so forth, the boom is still running. We're still set. The US is just marginally off yet another new record in this long bull run. Bitcoin is at $63,000. Meme stocks are flying high. Dogecoin is doing well. So what hasn't happened is that the other side hasn't really suffered. Now, I'm quite aware of the fact that despite the fact they've had a very good year, we know that this sort of late cycle environment is not good for value investors. Who knows where it goes from here? Clearly, if you get any sort of inflation problem, that's going to really accelerate the shift. But at the moment, I'm not confident enough to say that the old bull market is quite dead yet. So let's see what happens. You've got to remember that comparing the US sort of tech leaders, the FAANGs, with our tech stocks is probably not the best comparison in the sense that they're at a very different stage of development. In the US, we have very high quality, in fact, many people are suspecting semi-monopolistic companies with phenomenal cash flows and phenomenal earnings. In Australia, we have a lot of hopefuls on high multiples. I mean, let me give you the numbers. I mean, the FAANG stocks since the start of COVID have increased their earnings 70%. And in the last 4 years, it's been 180%. Astonishing profitability. On the other hand, if I look at the ASX GICS sector, the info tech, then since COVID started, their earnings have fallen 30%. And in the last 4 years, their earnings expectations are down 43%. Very, very different dynamics, right? And it's really worth emphasizing that because the FAANG stocks, they are the inspiration for the boom. But they're in a very different position to many other stocks. And I don't think you want to prize every tech stock as if it's going to be the next global monopoly. So the US tech stocks have to worry about Lina Khan and the Federal Trade Commission and antitrust actions. And we've seen what China has done to rein in their monopolies. On the other hand, I think our tech stocks, they have to actually start making profits. So it is quite different. And perhaps we can go back, we'll learn a little bit from history by going back to March 2000, because in March 2000, the US clearly had a tech sector that had some very good companies within it. While in Australia, I think it's fair to say our crop didn't do so well. We had all sorts of companies like Sausage Software and Solution 6 and OneTel and Davnet and so forth, who all traded on 60 times. And I should say 60 times sounds really tame compared to where they are now, because our infotech sectors are 90 times. But they had phenomenal runways, but they never took off, right? They stayed on those runways. So our tech sector post March 2000 fell 92%. In the US, it only fell 80% because they generally had better companies. So as we sit there today, perhaps there are better companies in Australia's mix this time round, but I think you can still fall 80% the way the Nasdaq did back then. There are prices where we would own all of them, but it is really a question of price. So we do look at all the large ones, and we're very careful to make sure that we don't miss the fact that companies that invest early in the life cycle show very little profitability, but it's because they're building market share and so forth. So we value these companies, let's say a Xero, which is a really good business. We value that on mature margins and on a market share basis. It's really just the multiples that are very hard to sort of get your head around. To us, they just seem incredibly demanding, and when multiples are very demanding, unfortunately, disappointment tends to follow. I spoke a moment ago about something dramatic like an 80% decline in prices, and you might say that's fairly fanciful and a bit dramatic and so forth. But cast your mind back to second half of 2017. I think the iPhone X came out, and we found out a lot of our politicians were New Zealand citizens. But it wasn't that long ago. We were already, what was it, 8, 9 years into the bull market, interest rates were zero and everything else. If the ASX, GICS, infotech sector today traded on the same multiple as it did in the second half of 17, it would have to fall 79%. Because all the gain over, in fact, more than 100% of the gain in prices in that period have been multiples. They're up 400% in that time. If I go back to 2015 multiples, the sector would have to fall 83%. So when you're on very, very high multiples, you're expecting the market to be very patient, and it's very hard to deal with shocks, particularly if there were any sort of tightening in the enormous liquidity conditions that we have at the moment, because finally interest rates do need to go up a little bit to stop the enormous inflation momentum.